Thank you for talking to us. My first question is on markets. It has become quite a boring market, Indian markets. What would be the next big triggers that will take it forward?
Yeah, so the trigger to my mind is going to be a softening in the RBI's tightening stand, because there is enough evidence that we can see that there is a impact of the rate tightening cycle on, and of course inflation, on consumer demand, both in rural India as well as in urban India. If you look at numbers of consumer companies, Asian Paints and others, it is telling you that there is a softening in demand. So I think the trigger is going to be the next policy meeting, when RBI probably should give a pause or enough indication that it is turning dovish instead of hawkish. I think that will be a big trigger.
Okay. Globally, do you think inflation is still a worry? Till a few months back, it was coming down, but recent numbers are like a bit worrisome. So do you think?
Yes, it is proving fairly sticky, which is of course a problem, and that's one of the reasons is that the Russia-Ukraine war is not ending anytime soon. So that will keep prices elevated for a reasonable length of time.
Right.
And of course, the fact is that both governments, the central banks globally and in India, have been probably caught napping. They were too focused on growth and less focused on price stability. And that is now hurting them. So I think inflation has proved to be more problematic than, frankly, anybody anticipated.
Right. And given this, the Indian markets are still expensive compared to global setup, if we see. Would you see pain for Indian markets?
India has always been an expensive market. I mean, from the time I have entered this business 30 plus years back, I have never found it trading cheap. And there is a reason for that, a very good reason. The reason is that aggregate index return on equity for Indian companies is far higher than that of any peer country. So people will compare in the good days with Russia, and Russia would be always in a single digit multiple, and India would be 15, 18 times. The fact is that in Russia, you don't have these kinds of ROEs. And ROE is the single biggest determinant of where the multiple for an index or even for a stock will be at. So India has always been expensive, but people need to understand there is a reason why it is so expensive. It's always been so, right from the early 90s.
Right. Yeah. So, like from your last call, bullish call on small caps, you have seen this pack had a decent run. So do you think the rally is done, or there's still some steam left there?
No, I think, again, remember, small caps are not going to be giving you steady compounding the way potentially large caps can. Okay, they will be very compressed period returns. So you will get returns in a short span of time, and then you will flatline for some time. In particular, when you talk about small caps. But I look at small cap numbers, I look at many companies I have investments in. I am very, very optimistic.
Right.
As a group, and of course you need to pick carefully. It's a dangerous space for the uninitiated investor. It is not an easy space to make money in. You will have many bombs going off here and there. We have bombs going off in large caps also, as we know, but more so in small caps.
Right. And what's your view on new age companies? I mean, with the recent correction, 60-70% fall in many of the stocks from the listing, is any company that is looking interesting to you?
So people miss the point. That's just because something has corrected 70% does not mean that let's say something was 100 and become 30, the 70% fall doesn't mean the 100 was justified in the first place. It should have, these guys should have listed maybe at 20. So in my view, they will become undervalued if at all they will become undervalued at 50% lower, maybe even 80% lower. You overvalued the IPO. So everything looks cheap in comparison to the IPO. That okay, they're down 70. But that 100 of the IPO was never justified. They took advantage of, let's say, foolish investors, and they pumped and dumped the stock. As simple as that.
So no company as of now?
There are far better ways to waste your money, let's put it this way. You should eat well, you should drink a good bottle of champagne rather than spending money buying these kinds of rubbish companies.
Right. So, I mean, you're known to pick small cap names early. Given the VC funding, do you think, even for you, has it become difficult to pick quality names in this space, small cap?
No, on the contrary. I mean, in fact, my view has been, and I continue to stand by the view that great companies are great because they've delivered long-term stockholder returns in the listed market. So if you look at Amazon, look at Apple, you look at Google, you look at HDFC Bank, you look at Bharti, and you look at several others, the trick was they listed within 2 to 3 years of their formation. They never had a lot of returns being captured by the intermediate investors, which is PE and VCs. They went straight to the public markets. Okay. And I am saying this to every decent small cap company that if you've got a good story which is profitable, okay, all the loss making, please give it to VCs. No problem, give it off to them. But if you're a decent small company with looking at a 1 year, 2 year horizon of profitability, please list now. Because let the investor in the market capture the return spectrum, which otherwise the VC comes and takes away this much, leaving very little towards the end, and which is why these companies are suffering. Right. All the new age companies, had they listed early, okay, that return would have helped them maintain a good public image. Today, these promoters are laughed at by the retail investors. While an Infosys, which listed very early, they are still gods, irrespective of whether they make money today or not for you. The perception is that these are great companies because they listed early, they delivered 20-25% over 20 years.
Correct.
Yeah.
So now talking about the economy, you recently said if George Soros is betting against India, that would not be a good step. But we have, in the recent times, we have seen Hindenburg report, then we have seen obviously George Soros comments. Do you think it might hit India's appeal in some way in the near future?
No, so let's segregate issues. Hindenburg is not a report on India. It's a report on a corporate group. I mean, I cannot understand why people start merging the two things, saying one corporate, as if there is no other company in India. I mean, there are great companies in India, fantastic companies. There are Tata groups, there is Birla Group, I mean, there is Ambani Group, and there are other smaller groups. You're saying that one company is equal to the collective reputation earned for India by all these companies? I mean, that's absolutely ridiculous, and that is being unfair to a great country in a great market like India. I mean, I find it, I get angry when people start to mix these two things. It's a company, it's a group which has been, in the news for all kinds of wrong reasons lately. It was in the right reasons when it was running up. Now it's the other way around. They will deal with it. It's their problem. It is not India's problem. It's not the Indian stock market's problem. It is an isolated problem, and it in no way percolates or seeps into the rest of the companies. People will buy good companies. Just because there was an Enron and WorldCom. Did people stop buying, American companies? There's a Wirecard in Germany. The DAX is trading at all-time highs. I mean, in China, you have many, many blow-ups. I mean, this is part and parcel of corporate life. So let's not mix the two things. Coming to George Soros has been a big supporter of democracy because of his history of having come out of the Holocaust, because he survived the Holocaust under Nazi Germany. So his belief is that the world needs more and more democracy, and he's vocal about it. And that's his point of view. I mean, to say that is again going to hit the appeal of India, I absolutely disagree. That's his point of view, whether you accept it or reject it. No investor makes decisions, or serious investor makes decisions based on isolated corporate events or the point of view of one person, no matter who that person is.
Right. So still, you as an investor, what would be the risks in terms of India's growth that you would be keeping in mind?
I'll be very straightforward on that. I'm absolutely clear. The risk in India is a huge number of companies with great rewards. But at the same time, as a professional fund manager and investor, I need to also look at risk. There is nothing called risk-free investing, particularly when it comes to equities, right? So the risk, if you ask me, I'm very clear, the risk is going to be the fiscal deficit. Okay, we are running a 6% fiscal deficit. Okay, government has indicated a glide path to, I think, 4.5 in 3 years' time. For a minute, assume that comes true. Okay, that is actually the government manages to reduce the fiscal deficit. Where will the reduction come? The reduction can only come in the discretionary part of the budget. There are non-discretionary or fixed parts like interest payments or salaries and the social upliftment, defense. You can't do anything about it. I mean, those are fixed. You have to meet those obligations. So the discretionary part is capex, and that is what has actually helped India in this turbulent time. And the government has done the spending. But if the government 6% comes to 4.5%, the cut will happen on capex. Okay. Because nothing else can be cut, correct? Sure. When you cut capex, you will end up having effect on growth, particularly of companies that have benefited from this capex. So we need to be a little careful that looking 3 years ahead, you should be I'm not saying be negative on companies benefiting from government capex, but at least be careful on that part of the market.
Got it. The last question is where to invest. Like, let's say if you have 10 lakh, I know it's 10 lakh is a very small change, but illustration wise, if you have 10 lakh today, where will you invest?
In my view, I'm absolutely clear. Pick 50,
Okay.
or at least 30 well-chosen small cap names. It's a straightforward hack, okay? And put equal amounts in each of them. So this is a marathon race. Put equal amounts on each runner, okay? There are 30 runners at the start. Gradually, the field will separate out. When you will see after the 5-mile mark that there are 5-10 guys who are ahead. In the middle, there are 15, maybe 18 guys, and the laggards, which are the last 5 guys. Eliminate them, take that capital, and put back into new runners or reallocate to the winners, which are leading the pack. That's the way you're going to make serious money in this. Statistically, 5 out of your 30 bets are going to be huge winners over the 2, 3, 4 year period. Which ones you don't know.
Right.
Okay, that's the way to do this.
So you're talking about equities, so nothing in debt, real estate, gold?
No, now that's a longer discussion, how much allocation. I mean, I don't believe an average investor should be putting more than 30-40% in equities.
Okay.
I don't think higher allocation is merited. There is big risk. We always know that, no matter what fund managers say, because that's their livelihood. They keep saying to put everything in equity, but that's not wise. Keep a decent amount in fixed income. Now rates are very good, very attractive. You should lock in those rates.
Right. So thank you, Shankar, for talking to us.
Thank you very much. Thank you for having me.